Hello friends, James Stevenson and Loki back with part 12 in my Tesla earnings forecast video review series. I mentioned Loki, so let's bring him into the frame. He's sitting upright, he's on alert, keeping an eye out for bad guys, stretching some. So in part 11 I mentioned that it occurred to me that the pace at which I was making videos, one video per chart, was not going to work because I was going to run out of days. So normally I release my forecast right in the middle of the quarter. This quarter I had more delays than usual in getting that forecast ready, so I didn't get it out until, a week ago. And so then when these videos started getting published a week after that, the long and the short of it is I can only get 16 days worth of videos published before Tesla reports production and delivery actual numbers. So, as we saw in part 11 when I covered 5 videos, I'm just going to have to cover more charts per video. You're still getting all the same content that you would if I were making one video per chart. You're just going to get a longer video in parts. Well, all the remaining parts are going to be longer than the first 10 were. Okay, let's share my desktop and show you this chart. This was chart the 17th post from my thread. So that brings us to the first chart we'll cover today. I'll do 6 charts. I'll end with the operating expense charts, and then I'll cover all the remaining charts in part 13. And then I'll save parts 14, 15, and 16 for everything else, which is a lot. So we got to get from the income statement at the bottom to all the stuff that I have below the income statement, up to the top again to cover production, deliveries, forecasting by model, and then all of the revenue and cost of sales forecasting detail. But for now, we're looking at this revenue chart, so let's talk about it. Here's a chart showing Tesla's quarterly revenue since 2009. The growth story continues. One of my favorite charts, and a lot of other people's favorite chart. They tell me in the comments when I post this to X. So what are we looking at here? This is just every quarter worth of revenue for Tesla, all on one visual. So, over the first half of 2023, Tesla made over $48 billion worth of revenue. That's nearly as much as they made the whole year, not even 2 years ago. The full year 2021 was $53.823 billion. Tesla nearly made that much in the first half of this year. And that's not unusual for this chart, right? If you go back, you'll see a lot of other times that something like that happened, where Q2 was nearly as much as the prior years, or the 2 years prior full year number, right? Well, in 2021, it did happen, right? The revenue in 2021 over the first half was more than the entire 2018 year's revenue was. So I like this way of looking at Tesla's growth story because the revenue is the top line, and the top line growth is what matters if you want to have bottom line growth. If you want to grow your earnings, the way to do that is to figure out how to sell more stuff to more people at higher prices, or some combination thereof, to make your revenue grow by more than the rate at which your expenses are growing. If you can do that, you're going to have more profit at the bottom line. Now, why are there no bars here, here, or here, 2009, 2010, or 2011? Well, $73 million isn't enough dollars for Flourish to even bother trying to chart the rectangle. It says, you know what, 73 million is a very small number compared to 81 billion, which is the size of the horizontal graph area. Now, when I first started making this chart, I think it was 2018 or 2019, you could still see these rectangles because, the scale of the chart was only a $20 billion scale instead of an $80 billion scale. So they all appeared back then. but they don't anymore, and that's the Tesla revenue growth story. So where will Tesla end this year? Probably way past $80 billion. I think we can agree just by glancing at this. I think it really helps to stay grounded looking at a chart like this when the numbers get huge, right? But most normal people don't have to think about $50 billion in the course of their everyday life. So it's like when politicians argue in a debate about money figures, everybody gets lost. Like they lose the entire audience. Nobody knows the difference between, 900 million and 37 billion, right? It's just, it sounds like Charlie Brown's school teacher. Wah, 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 right? Oh, I really got Loki's attention doing that. You get the idea. So on to the next chart. Tesla's operating cash flow and free cash flow have trended up and to the right for years despite huge spending on capital investments until they started ending the wave, which negatively impacts working capital. I expect improvement in 2024. So let's check out this chart. This is another one of those charts where you get something extra for free. What does the legend say you're getting? It says you're getting free cash flow and capital spending. So we have stacked capital spending on top of free cash flow. What's the title say? It says Tesla's operating cash flow, capital spending, and free cash flow combined, 12 trailing months. So the combined height of the two bars is Tesla's operating cash flow. And the way it works on the accounting statements is, first of all, you figure out what your operating cash flows are. Then you figure out how much you spent on capital spending, and you subtract that amount from your total operating cash flow. And that's how you determine how much is left over. The leftover amount is your free cash flow, which can be a negative number or a positive number. If your capital spending is more than all of your operating cash flow, then you have negative free cash flow, as Tesla did way back here in the first bar that I've charted here, Q3 of 2018, over the 12 trailing months. Again, all these numbers are 12 trailing month numbers. But yeah, Tesla's free cash flow over the 12 trailing months has been more than $5 billion of free cash flow the past 6 quarters running, which is pretty great. You would sure prefer to be a free cash flow positive company than a free cash flow negative company. Among other things, banks will give you better rates if you want to borrow money if you're a free cash flow positive company than if you're a free cash flow negative company that's burning cash, right? Banks worry about giving money to free cash flow negative companies that they don't have enough runway to get to profitability. So they charge higher interest rates or less favorable terms. All right, next up is a Stevenson Indicator trademark chart update. Don't forget the trademark indicator when you use the words Stephenson Indicator. I, James Stevenson, have trademarked this very serious technical analysis measure. Wink. For those who occasionally ask, of course, it's for entertainment purposes only and definitely not a price target. I think I've said almost every single time I've mentioned Stephenson Indicator, which has been a lot of times, that it's for entertainment purposes only. It's definitely not a price target. Do your own research. Not financial advice. Technical analysis is phrenology, etc. A tough bear market for growth stocks began in 2022. See Arrow, putting Tesla stock on sale for a while. So what do we have here? Well, it's a pretty interesting coincidence that not a lot of people have noted, but the bear market began on January 3rd, 2022. Now, we didn't find out that the bear market had begun on January 3rd, 2022 until like June or July of 2022 when, the economists who are in charge of measuring negative growth determined, that's when the bear market began. It was January 3rd, right? And this is not the bear market for Tesla stock in particular. This is the bear market for the U.S. stock market in total, right? So that happened, and then precisely 1 year to the day after that, Tesla stock hit its 52-week low. Now, there may have been other stocks that also hit their 52-week low that day. I'm not aware of any. Probably there were some other companies that also hit their low that day, but that's when Tesla's 52-week low happened. Exactly 1 year later, so it went from a little over $400 adjusted for splits. There was a 3-for-1 split that happened around this time frame, end of August 2022. And then we had that low to begin this year, and the stock is up 150% since-ish, right? So that's where we are, and that's Stevenson Indicator. What's Stevenson Indicator? Go watch my playlist if you want to have more information on it. It's just a dumb technical analysis line that a lot of people saw in this time period, and I've just kept extending that after Tesla's splits. What's up, Loki? Did you hear somebody deliver a package? Let me look. No package. Nobody there, buddy. I appreciate you keeping your ears open, though, and stretching. Alright, so that's Stevenson Indicator. I made a whole playlist of videos about what Stevenson Indicator is and isn't. What the Tesla haters, short sellers, and trolls will tell you is that it was my price target for Tesla every day for the past 3 years. I've never said that, but they've said it about Stevenson Indicator a lot over the years. Alright, the next chart in my thread says this chart shows Tesla PE compression over time based on the high, low, and quarter-ending stock prices. It may not stay this compressed very long when the bull market returns. Not financial advice, do your own research for entertainment purposes only, etc. So, I don't know if we're ever going to see these kinds of PE multiples again. These were pretty high, and they were at a time when Tesla earnings were growing a lot, right? Doubling every year. So that accounts for some of these elevated PEs back here. A lot of people will tell you that 30 is still an elevated PE. Well, is it? Gary Black sent out a tweet a couple of days ago arguing that the valuation of a stock is the future value, the present value of all future cash flows. Let me say it right. The present value of all future cash flows, not just next year's cash flows. So if you believe that a company is going to have several slow years followed by a lot of growth and then be the leading company in the industry or disrupt an entire industry and bring in hundreds of billions of dollars worth of profits, well, those count toward the valuation, right? You have to discount them back over a longer number of years. So the present value of those future cash flows is lower because it's going to take so many years for them to happen, but they still count. And that can make the PE ratio look a lot higher than mature companies that are trading at a PE of 10 or 16 or whatever. In the case of the auto industry, GM, Ford, Stellantis, workers are on strike right now. They were never very profitable to begin with, and it looks like they may not be any more profitable after they come to an agreement with their labor union. Those companies are trading at a PE of 4, maybe rightly so. Maybe that's the market pricing in, hey, the earnings for these companies are going to be less in the future than they are today, and that's why they're only worth a PE of 4. Is Tesla worth a PE of 70? Well, yeah, if you think they're going to be a $3 trillion company in the future or more, then yeah, you would definitely be happy to pay these valuations for them today. When they're trading below $1 trillion, you can triple your money or quadruple your money if you believe they're worth several trillion dollars, and today they're trading below that, relative to, you know, with a PE of whatever it is relative to trailing earnings. The trailing earnings aren't what matter. The future earnings are what matter, right? Some Tesla haters like to claim Tesla's operating expense numbers must be fraudulent because they aren't increasing by enough. That's true. Gordon Johnson does that. sometimes. That's mostly due to CEO stock comp, or was at the time that he was humorously implying fraud, because the operating expense wasn't increasing by the same amount revenue was increasing by. Well, why would it? Why would you spend as much more on SG&A and restructuring and other and CEO stock compensation and research and development as your revenue grew by? There's no good reason you would. If you were managing your company well, right? If you were trying to maximize shareholder wealth, you wouldn't arbitrarily just spend a lot more on that below the line stuff because the top line had increased by so much. So here's a chart that kind of makes sense out of this. You can see this really high number here, the highest number for any of the actual time periods over Q4 of 2021. What happened then? There was a one-time $340 million payroll tax associated with Elon exercising stock compensation from his 2012 bonus plan. So in some future year, or I guess as soon as this year, Elon could exercise stock options for Tesla. Now, he may wait until 2028, right before they expire, to buy them. But when that happens, there will be more payroll tax than this by a large amount if he exercises all 12 of the tranches he earned under his 2018 CEO Performance Award package. So what are we looking at? Well, the bottom bars are the research and development expense. So you can see that bottomed in Q2 of 2020 and has been increasing since. So when vehicles are in development, before they've gone into production, the expense associated with developing those new models or new products hits in research and development expense. So you can see that ramping up over time, and I expect that to continue to increase in the future, but not wildly, not by huge amounts, by measured increments. Then the bar above that is the SG&A excluding stock compensation. So these are selling, general, and administrative expenses for paying people who work at your headquarters, right? So your legal team, your finance team, your human resources, your security, all the kinds of jobs company headquarters need to hire for are in here before paying them their stock options. Then the dark blue is just the stock options that those people earn. The green bar is just the stock compensation Elon Musk earned as CEO. So what you're seeing here isn't Elon Musk being given stock. It's the gradual accounting expensing of stock options that Elon Musk has earned the right to buy by making progress towards the goals listed under his 2018 CEO Performance Award plan. So he had to grow revenue for the company. He had to grow EBITDA for the company. And the other one, was it deliveries? That doesn't sound right. It's been too long since I looked at this. So as he was making progress toward, market capitalization for the stock was the third one. So as the market cap of the stock, as the stock price increased by a lot to more than $650 billion, which was the top tier, Tesla's accounting had to recognize expense, even though there was no cash changing hands between the company and Elon Musk. He was just earning the right to buy more stock through the stock options that were eligible for him to earn under this plan. And the yellow is restructuring and other. Sometimes Tesla does layoffs, and when they do, the expense associated with layoffs hits in yellow on this chart. All right, so the last chart that we're going to cover in this video shows the subcomponents of just SG&A Within the larger operating expense group, the quarterly results sometimes make more sense if you examine the details rather than just looking at the totals. So I think it was Q4 of 2022 that Gordon Johnson said, hey, the SG&A is down year over year. How does that make sense when the revenue was up by so much? Well, if you just look at the numbers on a chart like this, you'll be able to see the reason. There's that extra $340 million worth of payroll taxes from that old stock compensation plan that Tesla had to pay more taxes to the government on. Then you had a regular, normal amount of SG&A stock compensation, very much in line with the quarters that came before and after. And then you had a lot of CEO stock compensation under the 2018 agreement, comparable to what had been earned over the previous 5 quarters, right? Before Elon had really earned nearly all of his, had vested nearly all of the stock options he could have earned under that plan. And then what I have out here is I'm just showing you my forecast that the board is going to come up with another stock compensation plan for Elon. And maybe by mid-2024, that plan will start and Elon will have started making progress towards achieving that plan's goals, whatever those are going to be. Okay, and that's this video. So that's part 12. Thanks for watching. If you liked this video, click the like button or on whatever platform you're watching. If you're not subscribed to my channel already, if you're watching this on YouTube, I'll leave you a link. Where should I leave it? I know. I'll leave it over here. You can click that link and subscribe to me for free on YouTube, or you can subscribe to me on Patreon for $4.20 a month, or on Twitter for $3 a month, which is only 69 cents per week. And a special thank you to my executive producers, Kathy Kitchler and RebellionAir.com, and I'll see you in the next one.